exactly now. All right. So shall we start? Yeah, I think it's time. All right. Perfect. Great. All right. So good evening, guys. Good evening to our friends in the east, and probably it's early morning uh, in the western part of the world, right? All right. Great. I hope you had a great week. Yeah, the markets are, having a lot of volatility. So I'm sure it's a lot of fun for a lot of people. Yeah. I don't know. I mean, how many of you guys are actually tracking the markets? Yeah, some of you guys do, some of you don't. All right. My screen's gone. Guys, can you, is it, wait a minute. Screen's gone. Wow. Now, how come the screen's gone? Okay. Can you see it now? All right. There was some issue maybe. I don't know. I don't know what, but there was some issue. Anyhow, now you can see the screen, right? All right, great. All right. Yeah. So, these sort of markets are actually fun to trade at. As you walk through the course, you'll realize, what different conditions, what different strategies work in what conditions. All right, great. So let me just start with today's lecture. So what I'll do is, in today's lecture, we will cover how to execute orders, right? So in the last lecture, we studied the type of orders, right? And I'll sort of brush those concepts again because we'll be using those concepts: pegging order, discretion orders, right? What is a passive order? What is an aggressive order? And then we'll try to walk through the algorithm to fire orders, and what is a good algorithm, and what are the things that we have to keep in mind when we have to execute our trades, right? So today's lecture would be mostly about that, right? Uh, and what I'll do is, now there were a couple of questions, right? In the last week, there's some students who had the same questions, right? So what I'll do is, if I get time, I will try to cover those questions in today's class. However, if I don't, then what I'll do is, I'll make sure that we set up calls. All right. But I'm almost certain we should be able to cover those questions in today's class, right? And there were a few questions about, VWAP strategies, RSI, and whatnot. So as I said before, what I'll do, I'll cover the concept of VWAP today, right? What is VWAP and whatnot. And then in my final lecture about the trading systems, I will go through a strategy with respect to VWAP with you guys, right? With examples, right? And RSI also, what I'll do, I'll cover it in my last lecture only because it just fits very well there, right? So I will be discussing a simple moving average strategy with you, and I will just, I will brush upon the part on RSI in that. So is that fine? Yeah. All right. So, okay. So let me just start so that, we have time towards the end. All right. So first thing first, you guys remember what a pecking order was? Yeah. Pecking order, discretion order. Do you remember from the previous class? Yeah. Yes or no? Yeah. Exactly. Right. So I'll just brush upon these concepts. Yeah, I know. You know what? I will just go through those concepts just one more time because those are important concepts for today's class. So let me make sure that everybody is on the same page with me. All right. You guys can see the Excel, right? All right. So this is the order book, right? This is the level. So the first level is the best bid and the best ask. Level 2 is the second best bid and the second best ask, right? So a pegging order is a limit order price, right? Where the price of the order is dependent on the price of a particular level at the particular level of the order book, right? So this is, I'll just explain it to you what this means exactly. And you can peg it to a particular level, you can peg it to the bid ask spread and whatnot. But let us say that basically pegging order is a limit order, is a limit order where the price of the order is dependent on the price of a particular level. So an order that is pegged at, say, level 1, right? So if I say that whatever the best bid is, I will fire an order 1 tick or 5 cents more. So I'm assuming that 1 tick is of 5 cents more than the best bid, right? So this means that this basically means my order is pegged at level 1 bid, right? So if this is the order book, and obviously I will not consider my own bid when evaluating the best bid, because otherwise it will be a recursive thing, right? And I will eventually hit the ask, right? So if these are the conditions, then where will I fire the order? At what price will I fire the order if these are the conditions? 5 cents, 100.05, right? So I will therefore fire my order at 100.05. Is this clear? Yeah. Now I could have done it at the second best level, pegged at second level. This would have mean I will fire the order at 99.55. Guys, is this clear? So this is important. This is clear. Is this clear to everybody? All right, great. So pegging is clear, right? Now, so this is a pegging order. What I'll do is I'll just quickly familiarize you guys with discretion order, right? So there's a question, is it based out of NSE? Because on NASDAQ and the NYSE, that is not how it works. It puts in line with the top of the book per time order. So there are different ways to peg it. That's what I'm saying. So these conditions can be absolutely different, right? So this is just one example of pegging, right? So you can do it anyways, right? So this is one way of pegging your order, right? The best level or the second best level. there's a question, can I explain the pegging at second level? Yes, I can do that. So this was pegged at, so my example, if the first pegging at first level is clear, then pegging at second level should be clear that, so what I'll do is, whatever the second best bid is, I will fire an order that is 5 cents more than the second best bid, right? So I will fire the order at, so this is 99.5 is the second best order. So what I'll do is I'll fire it at 99.55, right? So, and obviously, I mean, so this is clear. All right. Now, if the order at 100 moves to 100.05, right? Then I would modify my order to 100.1, right? All right. Yeah, placing an order and firing order is basically the same. It's just a terminology. Fire an order is just placing an order, right? Triggering an order, right? So is this clear? What happens when the best bid moves? All right. Yeah. So if I am pegged at the second level, then obviously it will not get executed till the best bid gets traded, right? So usually people don't peg it at the second level. Usually people do it at the best bid, but just for an example, I took it that way, right? There's a question: what happens if I peg it if the best bid moves to 100.45? If you have no conditions to check your order, then obviously you will fire an order at 100.5 and it will get traded, right? But usually, to avoid, such games, people. So if people can figure out that, you've placed a pegged order, then what they'll do is they'll quickly, move their best bids till you move to around 100.3, 100.35 and whatnot. So obviously you have to have an algorithm to check that, this is the highest level at which I will move, right? I will not go beyond this and whatnot. Is this clear? So there's a question: by the time 100 becomes 100.05, your pegged order will be executed. Why do you say that? So this is a bid, right? My order was a buy. So this is buy at the buy side. At the buy side. So I am basically pegging my buy limit orders, right? So obviously, if two people peg the order, then they will go on moving, right? So you have to obviously put in checks, and we will discuss those checks and whatnot, right? I will talk about, so I will talk about what happens. Will it create momentum, contrarian, and whatnot in the rest of the class? But is this clear? Is the basic concept of pegging orders clear? Yes, the pegging order keeps on changing till it gets traded. All right. Usually people code their own algorithms to use or to fire such pegged orders, right? I do it quite often, and I have my own algorithm to place and modify such orders, right? This is, so, guys, please don't get confused. Right? This is example 2, this is example 1. These are different examples. All right. Yes, I will cancel my previous orders when I'm pegging. So I will modify, right? I wrote modify. So I will not put another order. I will just modify my old order to a new price. All right. Is this clear? you can put pegged orders from level 2, level 3, level 4, level 5. It's up to you really. But usually, the level 2 and level 3 orders, it's tough to get them traded, right? All right. All right. So just a quick thing about discretion orders, because we're going to use them too. Discretion order would be, you would give your broker a discretion, or your algorithm a discretion, that it can modify the price of an order by a certain amount if it can get traded, right? There's a question, what is the economic advantage of a pegged order? I will tell you. I will tell you, why do people use pegged and discretion orders? But let us first get it clear that what is a pegged order, right? The second question, you have to modify it yourself, or the exchange or the broker? No, you have to modify it yourself. Your code will do it. It's an algorithm, right? And we will discuss the algorithm, right? So your code will automatically do it, right? All right. Do pegged orders appear in the order book? Absolutely, they do. They do. They do appear on the in the order book. All right. So going back to the discretion order, so discretion order would be that you would give your broker or your algorithm basically a discretion, right? Or your code a discretion that it can modify the price of an order it can modify the price of an order by a certain amount if it can get traded, right? So what happens? So say, you're, as an example, you fire a limit order at 100 point, say 1, right? A buy limit order, right? You fire a buy limit order at 100.1 with a discretion range of, say, 10 cents or 20 cents. All right, 20 cents. So there's a discretion range of 20 cents. So then, if this is the case, then your order book will look something like this, right? So, your order will easily sit at the best bid, and it will not increase your price. So with a discretion range of 20 cents, your code knows that it can modify the price till 100.3 if there is an ask at that price, right? So it will modify. So here it know that, even if it modifies at 100.3, it's not going to get executed, right? So it will just sit there. However, if after some time, so this is at, say, 10 a.m., say at 10:05, this ask moves to 100.3, right? So if there's another order, then your discretion range will be used and an order, and your order will be modified, and your order will be modified to 100.3 so that it gets executed. Is this clear? Is this clear? How will the code know? Because the code knows that there's an ask at 100.3, right? So obviously, if the code is obviously managing the order book, right? So it knows what is the ask price, what is the order book, and something like that. So as soon as it knows that there's an order for 100.3, so it can use its discretion and it can get it traded. All right? Is this clear, guys? Any questions with respect to pegging order? It is much more efficient that the exchange does this automatically. Yes, it was very efficient. But then, the code is equally efficient, right? It doesn't matter. So for me, a code or an exchange does it just doesn't matter because I don't have to care about it. There's a question, when I say modify the order, does that technically mean that it cancelled and replaced? Exactly. So modify is basically cancelling the previous order and just replacing it with a new order. You can do it in numerous times in a day. There's no limit to it. All right. What's the difference in putting a limit order at 100.3 versus 100.1 with 20 cents discretion? This is a good question, guys. This is a good question. What is the difference between putting it at 100.1 or and not at 100.3 straight away? The biggest difference is that it was quite possible that I would had I just put it at 100.1 instead of somebody moving to 100.3, it's quite possible that they trade at 100.1, right? So it was possible that I could have gotten a trade at a better price. And this is the biggest difference between a limit order at 100.1 and a discretion order with 20 cents. So it's quite possible that I didn't use my discretion and it got automatically traded at 100.1, which is a better price. Will the limit price of discretion order change if someone changes the bid to 100.2? Will our discretion order remain? No. See, this is the point. So you have to differentiate between pegging and discretion. Discretion is whatever my price, whatever my now you are asking some beautiful questions. Combine pegging and discretion. Yes, we can do it, and we will cover that in today's class. That is why how to combine them systematically, right? So that is what I will cover in today's class. All right? Is this clear? Yes, if your discretion order is at 100.1 and you've not pegged it, then obviously it can become level 2, level 3, whatever, depending upon the order book. So if this is clear, should I move on? Any questions? No questions? Great. Great. There's a question, if you are unable to get filled at your current limit, then yes, you are right. It basically means discretion is that you can, sort of aggress your order. There's a question, I usually use limit orders at the mid. Why do they get executed sometimes? Because there might be, I don't know which exchange, so there might be a hidden order there, or, there are, there can be algorithms working as, if there's a order at the mid price, then just immediately trade it, right? So there can be a lot of algorithms that are working, right? So there's a question, can I explain the difference between pegging and discretion? Yeah, so if you've understood pegging, and so I'll just repeat what a pegging order will do, right? Pegging order will change your price of the order depending upon the existing orders on an order book, right? So if I pegged it at the best bid, if the best bid changes, my order price will change, right? Irrespective of whether it will get traded or not. It is just a function of the price of, say, the best bid, right? Discretion order would be if my order is at a particular price and there's a range, say 20 cents, right? I will increase my buy limit price if I know that it will get executed, right? So I can increase it by 20 cents if I know that there's an ask at 100.3 so that it can get executed, right? Discretion can be used for any level, 2, 3, 4, 5. It's really up to you, right? There's a question about No, when I say modify, so any exchange will not, it will cancel your previous order first and then it will replace it. Like it does it pretty much at the same time. So it cannot happen that your new order gets executed and your old order gets executed too. It's just impossible. Either it will get cancelled and get replaced to a new price, or it will just, if you were too late, then it will just get traded, right? So if you've sent a modify, then it cannot happen that both the orders get traded. All right, guys. I mean, so yeah, you can read the protocol, how to modify and whatnot. So let me not discuss all this. Yes, you can use fill or kill. Absolutely, you can do all those things with these discretion orders, right? So can we say pegging order may get executed earlier than discretion order? It really depends, right? I mean, I'll have to. If you understand what a pegging order and discretion order is, then automatically you can sort of figure it out yourself, right? That what will happen, right? I mean, let us not make some weird examples, and I mean, I can do that, but let us not waste time on this. So I think we've discussed enough of these. Anyway, this was from the previous class, so let me just move on, right? I mean, I'm sorry if there are some questions that were unanswered. I'll take them either at the end of the class or offline, right? Because there's only limited time. All right, okay. So I really hope that you guys have understood the basic concepts of these two orders, right? Now comes, so what I'll do is, so I will use both these orders to figure out how we can best execute our strategies, right? So if we have a strategy, then how can we use these two orders or codes to sort of execute our trades, right? All right. So in a market, so in an algorithmic, if I have to discuss algorithmic strategies, right? Then they can be divided into, I've divided them into 5 major parts, right? Or 6 major parts. One is trend following, right? Something very similar to what we studied in the first class, right? The moving average strategies and whatnot, right? Those are trend following. The exact opposite to those would be contrarian strategies, right? Where people think that, the price of an asset has gone beyond its fair price and it will revert back. Market making, I've already discussed. Statistical arbitrage is, it's basically a short-term strategy that takes care of mean reversion models, and they basically try to exploit some statistical divergences. So something like lead or lag, right? So if I say that Microsoft and Apple, right? Or Microsoft or Google. So we can say that, if Google goes up by 10 points, Microsoft will go up by 5 points, right? So if I see that Google has moved up, then I will just quickly buy Microsoft. So this is sort of a lead lag statistical behavior that I've found out, and I'll take advantage of this. Right. And then there are delta neutral and market neutral strategies. Right. So, I mean, these are different types of strategies where algorithms are very helpful. Now, in any successful strategy, right, there are basically two parts to a strategy. One is the logic behind when to buy and what to buy, right, and at what price to buy, right. So this is the basic logic that if X happens, I will do Y, right. So this is the basic logic, the quant analyst part of the strategy, right, where quants and traders, they sort of figure out that this is the relationship in the market and this is what we need to do to make money. The second part is the execution of that strategy, right? And in my understanding, execution is very important. There are very good strategies that I've seen failing just because of poor execution, or similar ideas, very similar ideas where one works and one does not work just because one idea had a better execution, right? And so in today's class, we'll talk about how to execute your strategies in a better way, right? So then let me just give you an example, right? So this is the problem statement, right? A fully automated system for executing trades of a given financial exchange trade basically of an asset in such a way that it can reliably execute within a given time frame, right? While it takes advantage of real-time market movements and whatnot. So let me just give you an example, right? So what you want to do is, say you have a client and client calls you at 10 a.m., right? That he would want you to sell, say, 20,000 shares of, say, Microsoft, all right, at the best possible price today. So today only, right? So this is the call that you got. Now you have to execute this. This is not a strategy, right? This is done. So we'll talk about the execution part, how to execute things, right? So he would want you to sell 20,000 shares of Microsoft at the best possible. So let me create a scenario. At 10 a.m., the price of Microsoft is, say, at $120, right? And say it ends at 3:30 p.m. It ends at, say, 110, right? And then in between at 11 a.m. it went to 125, right? Now you managed. So at 4 o'clock your client calls you again at at what price did you sell all his shares, and you say that you got an average price of $150, right? Now, is it, should your client be happy or should your client be sad? Right? Any guesses how to figure out whether he sort of, whether you guys are whether you've got a good price or a bad price or whatnot? Any guesses, guys? Is the question clear? Not too happy? If it's so, some of you guys have, so he won't be happy, right? All right. So some of you guys have gotten the point. We can compare the VWAP. So there was a question that I missed. Maybe there was one question: difference between market neutral and statistical arbitrage. Yeah, all right. So Yogira, let me take this question towards the end, right? Because frankly, I will not use any of this in this lecture, right? So let me just focus on execution, and I will take all the leftover questions towards the end. All right. Now, so one way to compare if the price was good, bad is VWAP. Now, what is this VWAP? So it's a very simple concept, volume weighted average price. What is that? Say I give you some more information and it went to say 115 and then at sorry at 12 noon, right? And then at 2 p.m. it went to say $117 and whatnot, right? So say at each point of time, I'm calculating the number of shares traded at that price, right? And I'm doing it pretty much for each price point, right? So say at 120, 5,000 shares got traded, right? At 125, 10,000 shares got traded. At 115, say 2,000 shares got traded. At 117, say 7,000 shares got traded. And at 110, another 5,000 shares got traded. Now, at every point of time, you can obviously calculate that how many trades are happening at that particular time, right? You can obviously calculate. So if you have that, then VWAP simply tells you number of shares multiplied by the price, right? And I will do it for each time period, right? So I do this and so on, right? Or you know what, let me just do this. And then right, and so on. And I will divide it by, and then I will divide it by the total amount of shares, and then divide it by total amount of shares traded, right? So a simple way of doing it in Excel is sum product. All right. Divided by sum of the total number of. So it's 118.93. Right. So maybe your client would not be that happy, right? Because you sold it at an average price of 115 and the VWAP of the day was 118.93. No, my friend. So there's a question that, the sum total is greater than 20,000. No. This is VWAP is of the market, not of what you did, right? So we are trying to compare our average price with respect to what was the VWAP of the market, right? So this at 10 a.m. this is market. This is for market, right? Number of shares at that price in the market, right? So this has nothing to do with what. So it's quite possible that you traded everything near 12 noon where the price was 115, right? So is that clear? You see what I'm saying? The VWAP is calculated taking into account all transactions. That is correct. What do you want me to repeat? So is the concept of VWAP clear? How to calculate the VWAP? So we should, so VWAP of the market simply means that the number of shares that are traded in the market, not of the traded shares of the shares traded by you, right? I mean, so VWAP, so this is 5,000 shares were traded in the market, right? Irrespective, and probably you sold all your shares somewhere around here, right? So maybe, so if this is say 50,000, right? And then you sold your 20,000 shares at 12 noon, right? Is this clear? All right. So this is how VWAP is calculated for you. So now the frequency, you can take a frequency of 1 hour, 1 minute, 1 second. It's really up to you, right? It depends upon your time horizon, right? The sort of time in which you would want to trade, right? So this is exactly how you calculate the VWAP, right? All right. Will the VWAP change with respect to time horizon? Slightly. It might change slightly because at the end of the day, you'll take sort of, it depends upon the average price you take for that time horizon, right? So if you're taking the average price of 5 minutes as 120, where the volume weighted was 119, it might be slightly changed, but usually it won't be that different. All right. All right. Habib, I don't know how it was calculated in Sami, so probably we can discuss it, but this is how you do it. All right. Price is the, so this is the traded price. This is not the closed price, right? This is the traded price. Price at which the stock got traded, right? It depends this sort of data might be provided by a broker. It depends upon the exchange. I don't know if an exchange will sort of provide it, but obviously you can easily write. This is a very simple algorithm to write, right? If you know the trade price and the volume traded, then you can easily calculate the volume weighted average, right? All right. Typically, brokers will give you open, close, high, low for that minute, right? So candles like OHLC data for that minute and volume traded. So you can sort of take the uh, you know I mean, if they're giving you a VWAP for that minute, great. If not, then you can take the close price as the traded price for that. I mean, you'll have to make your guess, right? If the data is sort of not accurate. How did we arrive at 116.8? So it's just the sum product, right? 5,000 into 120 plus 10,000 into 125 divided by the total number of shares, right? So I changed this 50,000. Maybe that's why you are not getting it, right? Or so this is how you do it. All right. Now, how will the dealers use the benefit of VWAP to execute the orders of the client? So this is a good question. So that's what we'll do, right? So first of all, I'll just explain that in a minute. So this is clear. X shares each and P is that the total share. What will be the, all right? So what people do is, if you have to say buy or say, so our example was sell, right? So if you can sell the stock above the VWAP, it will be a good price. So say you got a call at 10 a.m., right? So obviously you will calculate the VWAP from 10 a.m., right? Or whenever you enter the market, right? And whenever, say, you said a time horizon, right? 5 minutes, 10 minutes, 15 minutes. And whenever, you think that, right now the VWAP is higher than the last 5 minutes, let me sell it at that price, right? So this is how algorithms work, right? This is again a simple algorithm to get a high trading price, right? So just calculate the VWAP for for if you starting at 10 a.m. till 10:05 till 10:15 whatever, and then once you sort of set a time horizon, whenever the price of the stock is greater than the current VWAP, you can sell it, right? You can sell a certain amount of stocks. Is this clear? Exactly. So if you're, so there was a question. can I assume that if the current VWAP is higher than my average price, so if your VWAP, no, so your VWAP, your current price of the stock should be higher than the VWAP, then you can sell it, right? Because you can sell it only at the current price. You cannot sell it at the VWAP, right? So your current price should be higher than the VWAP, and then you can sell it. Is this clear, guys? So, high frequency traders use VWAP as a very important benchmark for execution, right? So, and obviously the time horizon can be dependent on however you want to execute, right? There's a question, if the current price is higher than the VWAP, then will we continue selling? Obviously, there's a certain amount of share that you want to sell, right? So that's the objective. I mean, the objective is to sell. Now, sell, say, so 20,000 shares. So then, obviously, you will try to sell till you've exhausted your limit, right? So this is just one way of executing, right? Obviously, there is no guarantee that the price will go above or below VWAP. It is just a good way of doing it, right? So this is how it's done, right? So I hope calculation of VWAP is clear. Multiply price, corresponding volume, add. So remember, I used a very neat trick in Excel, sum product. So that's a very simple way of doing it, right? All right. There's a question, VWAP versus just average. Why aren't we using just the average? Because, it gives more weightage to the prices where more trades are taken, right? So, and, a lot of traders believe that, in fact, some traders mark the price points at which a lot of volume is traded, and they treat those price points as as some very sticky price point, and it's quite possible that the stock will trade in that range and whatnot. So traders usually give volume a lot of weightage. If the stock is at 100 and only one share gets traded, but if it moves to say 99.5 and 1,000 shares get traded, so in some of the traders' mind would be that probably 99.5 is a better fair price of the stock or whatnot, right? Can VWAP be combined with strategies? Yes, you can do. So again, please let me repeat it again. Please pertain to the things that are being discussed. If you have questions regarding VWAP, what is VWAP? How do we calculate it? We can have a very long conversation on the multiple possible utilities of VWAP in a different forum, right? So, but let us keep it. So my objective over here is that you should understand whatever is being taught, right? All right. How HF traders use VWAP? Yeah, so they will calculate. So if if the strategy has to sell at a particular stock, right? So it's pretty much similar to what I've discussed, right? So it will calculate the VWAP for every whatever time horizon, and then it will sell only if the current price is higher than the VWAP price, right? So there's a question, if the market starts at 9:15 and we want to start trading at 1 o'clock, then when will we see VWAP? You should see VWAP from the starting of the day. But in this example, if I have to compare whether I got a good price or a bad price, then for comparison purposes, I would only use the VWAP after 1 o'clock. But obviously, for selling or for strategies, I should use it from the start of the day. All right. So three key elements of Krishna, your question is sort of unrelated, but we can discuss it offline, right? So analysis of incoming orders is obviously important for VWAP strategy, right? You should know at what price the orders are coming and what price they are getting traded at. So volume distribution is what, uh, your system should automatically calculate how many orders were filled at what price and to calculate the VWAP, right? And obviously the final component would be to fire orders intelligently, right? If the current price is higher than the VWAP price, then you would want to fire a sell order. All right. How to get order books data? Please, you'll have to figure out. You'll have to ask your broker or vendor, right? Or you can get historical data to calculate all these things. All right. All right. When I say the current price is between the bid and the ask. So that is what the current price of the. Now we should not use trading price and whatnot. It's between the bid and the ask now, right? Now that we know what a bid and the ask is. Yeah, in this case, the VWAP strategy is oriented to maximize the efficiency on order execution. Exactly. So in today's class, I'm only discussing order execution, right? I'm not discussing strategies. All right. All right. So order specifications. You obviously know for an order, you should know what to buy, the trading symbol, side, right? Buy or sell, you should know the size, the price. Now there is again, I will discuss, there are two more points, urgency and time horizon. Time horizon, you obviously know, right? If I want to sell 20,000 shares, or if I want to buy 10,000 shares, do I want to do it today or in a week, in a month, whatnot, right? Urgency, I will take urgency and time horizon, later in this class. So let me just leave this right now. Any special instructions? Special instruction, if that there's a price limit, I cannot buy at a price above this, I cannot sell it below this and whatnot, right? So limit orders, you obviously know this, right? There's a question, do we have simulated limit orders book to test strategy? Ramesh, offline. I'll take it offline, please, right? Size, so size is minimum size and maximum size. This is, don't worry about this. I will cover what a minimum and a maximum size. This is basically your algorithm will set that what size to fire, right? And based on, so minimum size and maximum size can be based on the number of total stocks that you want to sell, right? So I will discuss these finer points, but obviously you know what an order looks like, right? Important point to look at limit orders is limit orders passively wait for the market to move in your favor, right? So if you have a buy limit order, you just wait there and you actually wait for the order to get executed, right? In this order, you have complete control over the execution price, right? You have complete control over the execution, but you have no control over when it will get executed. You might have to wait for 5 minutes, 10 minutes, an hour, 1 second, you don't know. So one extreme is control over price, no control over time. Second was, so this is a passive, sort of a passive order, right? An aggressive order is immediate execution. You remember market order, right? This is the other extreme. It will get immediately executed, but you don't know the price, right? Because the price can change. Right? So these are the two spectrums. One is passive, one is very aggressive, right? There's a question, what is the shortcoming of VWAP? I mean, it's only, there's only limited intelligence in a VWAP strategy, right? I mean, there can be many more indicators to sort of figure out what is a good price to sell. So, but VWAP is a good strategy to figure out if a price is good or bad to execute for starters, right? So, its only limitation is that it's just it's only one indicator, right? Usually people use a lot of indicators to do that. All right. Now, why would anybody bother? So, I had a nice little graph ready for you guys. So let me just sort of hide this, right? So this was, I just wanted to sort of show you the play between, between passive or being passive in the market and being aggressive in the market, right? At the cost of probability of getting executed, right? Your order getting executed. So I have a neat little graph to sort of show you this, right? So say this is your order book, right? Same order book. This is the fair price, the mid-level price, right? And this is the bid-ask spread, right? Now, what I've done is, now if you are at, say you fire an order at the best bid and you get executed, right? So I'm just assuming that the fair price is the mid of bid-ask for simplicity's sake, right? This is just for an example for simplicity. If I get traded at the bid, right, I make a profit of if I buy at the bid, right, at $100, I make a profit of 25 cents. Yeah. If I get traded at 99.5, I make a profit of around 75 cents. Yeah, from the mid price. So this is the mid, right? So this is the mid, right? So this is so the mid won't change, obviously, right? So the fair price does not change, right? Now, so if you get hit at level 1, right, your gain is 0.25. If you get traded at level 2 at 99.5, your your gain is 0.75, right? If you get traded at level 3, your gain is 1.25 and whatnot. And then there is a certain probability attached. If you're at the best bid, so I've just taken some function, right? I've just used some function. Obviously, if you're at the best bid, your probability of getting executed is higher. If you're at level 5, your gains would be high, but your probability of getting executed is very low, right? So you'll always see a chart something like this. As your gains increase, your probability of getting executed decreases. Is this clear? And this is very important, right? So there is a very fine balance between how aggressive you want to be and how passive you want to be. If you're really passive, yes, your execution price might be great, but you might not be able to get a lot of trades, right? And if you're too aggressive, you might get a lot of trades, but then your gains might be very bad. So this is, can I show you the formula of probability? I just sort of did it from the distance of the best bid I took a function of the bid-ask spread and how far you were, right? So I mean, I just took this is an example. These are not real probabilities, but with historical data, you can actually calculate these probabilities for a given time frame, right? So I mean, obviously, and a lot of people do this, right? So and they sort of figure out that what is the best level to be present at and whatnot, depending upon your own risk appetite and whatnot, right? So that's what I'm telling. This is a this is a rather I would say a rough estimate of the probability. I mean, I just took a function of the distance between the bid and the fair price, frankly. And so please don't rely on these probabilities. You can just take them as examples. But in reality, you can actually calculate these things, right? So the graph is simply showing that the key takeaway from this graph is that there's a fine balance between how passive and how aggressive you want to be in your limit in your orders, right? If you're too aggressive, your gains would be low, your probability of getting executed will be high. If you are too passive, your gains would be higher, but your probability of getting your trades would be low, right? All right, so I hope this is clear, right? Right. Okay. Now, I just want to show you. So when I was talking about the VWAP and whatnot, I just want to share a quick example with you guys. So there was an example of Richie Soya. There's a share that is traded in India, and I will share this link with you. People actually manipulated expiry prices through this. So what people did, they so what happens on expiry day? In the last half an hour of the expiry day, the final price is calculated by the VWAP of the last half an hour. That is how it happens in NSE in India. So what people did, they took huge positions, huge buy orders towards the last 10 minutes or something, like last 3 minutes of trading, just so that the VWAP, the volume weighted average price, could change, and they made a lot of money through that, right? So this is an interesting link that you guys can sort of read, and you can see that how people use VWAP to actually manipulate also, right? Obviously it's absolutely illegal. If you're caught, you'll be jailed. And I haven't I'll give you an example of a person who was caught cheating in the exchanges, but that's fine, right? So I mean, if you're interested, you can just yeah, I will definitely share this link. All right, so this is clear. So you sort of know what a pegging order is, what a discretion order is, how how people can execute their strategy through VWAP and whatnot. And then you sort of got a understanding of what a passive order and what an aggressive order is, right? All right. All right. Now there was one of our colleagues, one of our students was saying that can we mix pegging and discretion? And yes, we can, and I would rather have you guys use this, right? This is a very good way of executing things, and frankly, I do it this way, right? So I mean, it's I and I will give you a very naive logic also of how I peg and whatnot, right? So I can do that. Right? So I will do that towards the end of the class, right? So so for example, right, what I'll do is I can write an algorithm which will peg my order to say 5 cents, right? To 5 cents of the best bid, right? So if the best bid is at 100, I will peg it at 100.05, and I'll have a discretion range of say 20 cents. So I will blend the pegging and the discretion together, right? Right. So what this will do is it will adjust my order price such that it is always equal. So here it's saying equal to the current bid, and here it is, in this example, it is taking a discretion range of 1 tick, so 5 cents, right? So in this, the great thing about this is that it has the advantage of both pegging, which is sort of staying competitive. It is a passive order, but obviously the probability is pretty all right for it to get traded, and it also has the advantage of being aggressive with discretion, right? So pegging and discretion together give a very good way of executing your orders, right? So as I said, right, you can think of them as two independent trading people, right? One is a passive agent, passive trader, who maintains the limit order, right? And it sort of pegs to match the market movement, right? And the second one is aggressive. As soon as it watches the bid ask, right? As soon as the bid ask narrows, and because you have a discretion range, it will fire a market order to get a trade, right? Is this clear, guys? Is the advantage of blending pegging and discretion orders clear? Yeah. So what should I explain again? Tell me. What part did you not understand? The view, or how to blend, or what? Can you just elaborate on that, and I will explain it again. How to blend? So, all right. So I'll just give you an example. So I mean, it's pretty much. I'll give you the same example, right? So this was about discretion range, right? Okay, there are a couple of questions. I'll take them one by one. So first, how do I blend it? So what I'll do is, so I will, so, okay, let me just take another sheet and, so this is blending, pegging order and discretion order, right? So what you will do is, I will peg my buy limit order at best bid plus 5 cents, and I will have a discretion range of 20 cents, right? Or best bid plus 10 cents, and a discretion range of 20 cents, right? So if I've done this, I will fire an order at 100.1. If the ask is 100.5, it will just sit there as a limit order, right? It will not do anything, right? Or, right? If the ask goes to 100.3, my discretion range will be used and my order will get executed. So this is case 1, right? Case 2, it's quite possible that the ask does not move, but the bid moves, right? So if the bid moves to 100.2, then I will modify my order at 100.1 to 100.3, right? Because this is 10 cents better than the best bid. And so as soon as I come to 100.3, right, I will use my discretion range to fire an order at 100.5. So this will actually, you know, with this, I will actually get a trade at 100.5. But this is blending of discretion and pegging. Is this clear? In regular orders, price is predefined. Absolutely. Limit orders, price is predefined. How do I arrive at discretion range? This is a good question. Discretion range actually can be calculated based on historical data. It can be based on microstructure. It can be based on historical data. You can calculate your probabilities of, this was the order, this got traded at this price. When the bid ask was narrow, this is the probability of an order getting traded and whatnot. Right. So based on this, you have to sort of, I see this pegging and discretion as two knobs, right? When do I dial my pegging order knob? When do I dial up my discretion order knob and whatnot? And so these are sort of knobs, and I can set their limits, right? Do I want to be really aggressive? Do I want to be passive? Right, depending upon how urgent it is for me to sell, right? So it really depends, right? And obviously you should have an understanding of the historical data, right? This is a question, why don't I peg it at best bid plus 0.4? You can do that. But then you will never. So it's quite possible that I could have gotten a trade at 100.1 also, right? So remember, if you increase your pegging order to a lot, then you are basically doing, you are making your passive knob very aggressive, right? I would rather not play with I would make my passive knob, I will keep my passive knob passive, and if I need my order to be aggressive, I'll just increase my discretion range. You see what I'm saying? So that is why I want you guys to look at these two things in this view, right? So pegging is sort of passive and discretion is sort of aggressive. You can, absolutely. You can limit your pegging and discretion order so that you can take advantage of VWAP also. Yeah, absolutely. So with if you have a VWAP, right? So you know when to sell, but as soon as you know when to sell, you should use pegging and discretion to sort of execute that sell. All right. Now, what are the drawbacks of, say, pegging or discretion, right? There was one of the students asked me that, can it cause momentum and whatnot? Absolutely yes. Right. So let me just take an example of how it creates momentum, right? So, say the current market is at, 10 and 10.15. So this is the bid. Bid is at 10. Ask is at 10.15. Right? Now, there are 5 buyers at 10, right? And a buyer comes and it pegs an order at 10.1, right? Now, it's quite possible that, all the buyers go to 10.1, right? Just because of pegging, one person pegged it to 10 cents. So the bid order came at 10.1 and then buyers are following. A single movement caused a movement of nearly 1%, right? Which might indicate a sudden increase in demand, right? And if all the buyers are sort of pegged to each other prices, they will never lower their price, right? And it will just sort of create a momentum, a spiral effect, and the price might move up. And similar, and then if there are a lot of trend following strategies that are going on, price might just go up and up. And there's a there's a very nice article about this guy. I'll just show you and what he did. So again, I'll share this link. So it's not found. Hey, what did it do? So maybe okay. So flash crash trader made 40 million. Yeah, the Hound of Hounslow. So he was named the House of Houndlaw, right? So what this guy did, he made $40 million by manipulating the markets. So what this guy was doing, he was spoofing the markets. So what he'll do, he used to fire very huge orders on one side, and before them getting executed, so he used to fire like huge sizes on, say, the sell side, right? So it seemed that it seemed to traders that there's a huge sell side pressure, so the prices used to go down, and so before his order could get executed, he used to cancel them, right? So for like fraction of seconds, there was a little movement in the stock market, in the price of these asset, and then if the stock in a fraction of second moved by, say, 10 or 20 bips, he used to buy it. Actually, instead of selling it, he used to buy the stock, and then in another fraction of second, when the price actually reverted to its fair price, he used to sell it. So he made a lot of money just by spoofing the markets, right? So for people who were questioning that, does such momentum really exist? Yes, it does. And people, this guy made millions just by doing this. And the interesting thing was, now obviously he was sort of caught doing all this, and so this is a clear case of manipulating the market, right? Because you are sending huge orders with not an intention of selling, actually. And the interesting thing is that why he got caught was because when the regulators, they simply asked him one simple question, right? That, did you use algorithmic orders to trade? And he said no, right? Had he said yes, then probably it would have been very difficult for the regulators to catch him. But because he said no, so he was sort of caught lying to the regulator, and he was actually prosecuted because of this line. Not, I mean, frankly, figuring out that somebody is manipulating the market is pretty difficult. But he was actually caught lying, so that is why he's actually, I think, serving a jail time right now. But so momentum in the market exists just simply because if a person sends a huge order, or if he pegs, then buyers might follow just because of trend, right? So obviously so there's a question, he could have gotten filled. So maybe he was at level 2 or level 3. I obviously don't know the exact algorithm, and you can read the online article. But the point that I want to make is that momentum exists in market, and people actually try to take advantage of these things. And these are basically, these are called guerrilla algorithms, right? And if traders sort of catch a particular algorithm where you are pegging and whatnot, they actually use these guerrilla algorithms to sort of figure out that this is what you're doing, and they'll find a loophole in your algorithm, and they'll trade they'll take advantage of your orders. So you have to be pretty careful in all these, right? So there was a question, how do aggressive, so large volume trades can benefit from VWAP and pecking? Absolutely. Can I fire an order pegged to time varying VWAP with the discretion? Absolutely, you can do that. Yes, you can do all sort of combinations, right? Okay. So there's a question: does an aggressive trader always look for when bid-ask spread is low? Why? Yes, an aggressive trader. So see, if your objective is to say sell the share, right? You know this is your objective. If the bid-ask is pretty small, then you are not paying a lot of. So remember, if I'm defining my gains as a difference between my order and the bid ask and the fair price, and I take the fair price as the mid. So if the bid ask is low, then and I'm firing a market order, my loss would be less, right? So you can just imagine if there is an order uh, at 100, if the bid ask is say 100 and 101, right? If the bid is 100 and the ask is 101, and I fire a market order, this will get traded at 101. However, if the bid ask is 100, so say the fair price here is 100.5, right? And however, if the bid ask is just 100.4, 100.4 and 100.6, so loss cause of a market order would be 0.5, right? However, here it would be 0.1. So obviously if the bid ask is low, then I would want, my losses for a market order will reduce, right? There's a question: can we have a hard block on the price with blending peg plus discretion? You should have that. So let me tell you, right? If your pegging logic is only to be 5 cents better than the best bid, right? Then there could be guerrilla guerrilla algos who will make you. So if the bid and ask is say this, right? This is just an example, right? If this was the bid and the ask, you fire an order at 100.05, right? So what these guerrilla algos will do, they'll fire an order at say 100.2, right? Then guerrilla algo will fire at order at 100.2, and then you will fire, and if you don't have any built-in logic, you will fire at 100.25, and it will just it will just aggress you, and then at one point of time, the same person might sell at your pegged order, right? Just to increase, just to make his sell price better, right? And frankly, you have to sort of figure out that this is the price beyond which I will not peg, right? Or something like this, right? So guys, can you hear me? Guys, can you hear me? All right. So maybe so one of our friends couldn't hear me. So maybe it's you then, right? Because you guys can hear me, right? Yeah. All right. Perfect. There was a question. Is it possible to limit my pegging order to certain price limit? Example, bid 10 and ask 12, but my pegging order should not go beyond 11. Absolutely. So that's what I'm been explaining, right? In fact, you should have that as an inbuilt logic, because otherwise there are some very very smart algorithms that will game you. And believe me, uh, I have seen people learning this the hard way, right? I mean, there was a trader who was like, I always get a bad price and whatnot, and the market moves against me. And then when he checked the data historically, he was like, there was actually an algorithm that was just working against him to sort of aggress his order, and then he used to get a bad price just because of those smart algorithms. So these are very, very common in the market, right? So this is clear. All right. So again, a discretion is sort of cumbersome to use, but I mean, frankly, in today's algorithm, it's pretty, it's pretty regular to use these. The thing with discretion is that it's sort of static, right? And that is always the case with market orders, right? That it does not react to market changes in real time, right? It's quite possible that you fired a market order within your discretion range, but still you might not get a trade, right? Because the order got cancelled or whatever. But that's these are these can happen with any strategy or any execution strategy. So if you use your pegging and discretion range, there might be a number of to manage a number of such stocks would be difficult. So obviously you have to use algorithms, right? You please don't even imagine using these things without an algorithm, right? So now discretion is sort of, as I said, it is a measure of aggressiveness, right? Now, if there are, if there is a time limit, right? Or there's only so much, stocks that you can sell at in a particular time without impacting the market, right? And I will discuss that. Then you have to, you have to sort of bounce back that order, and I will discuss when you should simply reject that. This I won't be able to execute this order, and we will discuss this, right? It's cumbersome because number of orders being worked simultaneously. Frankly, in today's world with great order managers and whatnot, this is not a drawback, right? So what I will do is or what, so let me just discuss that, and then I will take a break for 5-10 minutes, right? All right. So now with the pegging and the discretion blending, your problem statements become that you have to specify the number of stocks that you want to sell. What is the peg order price? What would be the discretion range, and how to determine how much to peg? What is the discretion range, and what is the best market code that I can send my order at? And for all this, obviously, you have to base all this with respect to historical trading data, right? And sort of probability of completion and whatnot. So obviously this is a good way of executing, but then to sort of quantify those things, how much to peg, what is the discretion range, you have to sort of calculate these things through historical data. What I'll do is, it is 5:30. So what is the time? So it is exactly 5:30. We will reconvene at 5:40. All right? And I'm still here to answer your questions, right? How will we set guidelines on how to develop? Will we get a set of guidelines on how to develop an algo? So today I will discuss a very simple algorithm for execution, right? And then in the later classes we'll discuss strategies, right? When to buy, what to buy, and what not. So if you combine this, then basically you have an algorithm for an automated system, right? So today is mostly the execution part, and in later classes, when we are familiar with futures and options and lead lag and whatnot, then we'll discuss how strategies are built, right? Question. So can you just repeat the question too? What book do I recommend on market microstructure? So there's a book by Larry Harris, as suggested by our by support, right? I will share a simple algorithm for execution, right? All right. There's a question. You're still not clear why we need to blend pegging and discretion. So you see, you understand the difference between a passive and an aggressive order, right? So a passive order would be, you're just waiting for that order to get executed. Now say if your objective is to sell 10,000 shares in a day and you're just waiting, you might not get executed at all, right? You might not trade at all. Now that's a bad strategy, right? And if you're too aggressive, you might sell all your 10,000 shares but at a very bad price, right? So intuitively you should sort of feel that, I don't want to be extra passive and I don't want to be extra aggressive, right? So you need to blend aggressive and passive nature. And frankly, this is all blending the pegging and the discretion order is all about. Yeah. So, in my opinion, the only drawback of this would be to figure out what is a good peg price and what is a discretion rate. Frankly, I mean, if you have a good automated system, then figuring out scaling up to a number of stocks or managing a lot of orders is not a drawback. I mean, if you're doing it manually, then yes, this is a drawback, but you should have an automated system for this. And if you have an automated system to manage your orders and whatnot, then that's not a drawback, frankly, right? So there's a question. So one of our friends is saying that a pegged order is a functionality that is given by by the broker. So obviously you can use that. I mean, it's up to you. If you deem the logic to be good, then you can use it. But there's only you cannot customize whatever your broker is offering you is not customized, right? So if you're really interested in algorithmic orders, I would rather have you develop your own codes for your own order execution, right? I mean, there's only so much. I don't know which broker you're talking about. If he's really good, then obviously feel free to use it. But then I don't know if you will be able to blend a discretion range and if you can change how customizable it is, right? So it's I mean, there's no harm, and I mean, you don't have to reinvent the wheel if it is already there. But I would rather, I mean, for me, you know I'm very particular about these things, right? I exactly want to customize everything according to my needs, right? So Balakrishnan, I hope your question was clear. There's a question: if I'm placed at 100.1, discretion order of zero point 0.2 and best bid is 100.3 and some one best ask is 100.3, will our order supersede best bid and trade? Yes, it should. Yeah, it will. It will. It will. It will supersede and it will get traded. All right. Uh, there's a question. Naba Mehta, I've calculated VWAP in Excel earlier and found the outcome. Can you please share the data with me offline and I'll figure it out? There must be some calculation mistake or something. Or there, I don't know. The exchanges might use a very convoluted way of dealing with VWAP. So, just share the data with me and I'll look into it. Absolutely. Not all brokers will have that option of pegging, right? So it's always, I prefer, right? And these are simple algorithms to write, right? All right. Any question that I missed? So Balakrishnan, as I said, there are a lot of, I mean, you know, the presentation says that there are drawbacks of using discretion and whatnot, but frankly, for me, these are not real drawbacks. If you have a good automated system, I won't care about such drawbacks, because I mean, if you are trading manually, then this is a drawback. But I assume that you guys will not be trading manually with all these things, right? So frankly, these are not big drawbacks, right? So Manish, I'll take it offline, right? If you have a problem with order sending or whatnot, we'll take it offline, right? Ravi, I'll see if we have time, then I'll discuss it. What is the max duration for VWAP? It really depends upon. There's nothing as max duration, right? I mean, it really depends upon your time horizon. I mean, people, if you have a month to execute your order, then your duration can be 1 day, 2 days, right? I mean, it's really up to you. All right. Okay. So is this time we have another 2 minutes? How much will it differ, blended order versus market order? Depending upon how the market is trading, you can definitely get very good execution prices if you are blending it. I mean, see, if the market is, obviously it will depend upon the market conditions, but just by experience, I can tell you that you can get extremely good execution prices. I mean, to give you a simple idea, you can mostly you can save on the bid ask spread. Let me, a rough estimate is that if you blend it nicely, you can easily save paying the bid ask spread, right? Ravi, let me take this offline, right? All right, so I'll just wait for another minute, and then we'll go to terminology. All right. All right. So guys, I hope the execution part is getting clear, right? How people in algorithmic trading execute their orders, right? How they blend, how they use simple tips and tricks to sort of get better prices, right? All right. Yeah. All right. So now it's time. All right. So now that we sort of know how to blend and whatnot, just before I discuss a simple algorithm to sort of figure out how to send orders, let me just just get this terminology out of the way. So bid, you obviously know, best quoted bid price. Ask, bid size is the current size quoted at bid. Ask size is the same for the ask. Spread is the bid ask spread, right? Marketable prices, ask for buy orders, and so whatever will get immediately executed, the price that will uh, the buy order will get immediately executed. Same side depth is basically the sum of bid quantities for a particular level. So right, so for level 1, it would be all the buy orders at the best buy, right? For same side depth for 2 levels would be sum of orders for the quantities for level 1 and level 2, right? So same side depth. So usually this is for the best level. So bid size for all the buy orders, right? For that level. Opposite side is so ask size for buy orders, right? So if I'm sending a buy order and somebody asks me what is the opposite side depth, then I will tell him that, at level 1, the opposite side depth is the sum of all the quantities at the best ask. All right. More aggressive is if the price is more aggressive than if price X is more aggressive than price Y, if it is, if X is greater than Y, right? For buy orders, obviously. For sell, if X is less than Y, right? So it's as the name suggests. More passive would be the opposite of it. Depth ahead. Depth ahead is the aggregated size at all price levels more than the order price, right? So if I take an example, right? So if I had, so let me just delete these things. So these are the quantities. So say 100, 200, 50, 10, and then say 30. Right, and here we have 500, 250, 100, 300, and 500. Right. So if this is how it is, then the depth ahead. So the depth ahead of level 2, if I'm at 99.5, the depth ahead is 500, right? All right. Aggregated size at all price levels, more aggressive. Alone at inside. So alone at inside simply, excuse me. Alone. So say if this is the order book, right? And you fire an order right, and if you fire an order of 200 quantity at 100.1, right, and so there's an ask at, all right, so your order is alone at 100.1 because your quantity, right? So if trader 1 fires an order of size 200 at 100.1, then this order is alone right here, right? It is the order price is equal to bid or ask, and same side depth is equal to order size. So the same side depth for the best level would be 200, right? So here the same side depth at level 1 is 500, right? So if the same side depth at level 1 is equal to your order quantity, then this is alone at inside, right? Is this clear? Guys, is the terminology clear? Guys, can you hear me? Yeah? All right. All right, great. Same side depth is nothing but it's the bid size for all the buy orders, right? So same side depth is 500 here, right? Because at level 1, so mostly it is quoted at the best bid. So it is all the sum total of all the order quantities at the best bid, right? Alone is if your order is the only order at the best bid, right? Right? Is it clear? So because the same side depth would be equal to your order size. Yeah. So here the same side depth is 200. That is correct, Carlos. If you are the only one bidding at the same price, then the same side depth will be your volume size, and you will be alone at that price. All right. So, all right. Now, so you know the conditions, right? Usually the same side depth is at level 1. That is how people usually define it. But if it is given that same side depth till level 2, then you have to add all the order quantities till level 2. All right, I will add. So there are 5 trade. So there are 5 traders at 100 with 100 quantity each, right? So if this is the case, then the same side depth is 100. You are alone because one trader at 100.1 with 200 quantity. All right. So this is alone, right? And same side depth here is 200. It's 200. All right. Great. So now obviously you know all these conditions, right? So you know what pegging can do, right? It can sort of create momentum, and you must disguise your pegging, and you should have a maximum price after which you shouldn't peg, right? And then obviously you have a discretion range. It might be dynamic based on the bid ask spread and whatnot, right? And you have to figure out what is the probability of you getting a trade if you are passive, what is the probability of getting a trade if you are aggressive, and you have to sort of play accordingly. Now, there's an important thing that people use in high frequency in algorithmic orders, not in high frequency, in algorithmic orders, right? So if you get an order, right? So say you get an order from a client to sell, say 10,000 shares, right? Obviously it will tell you what symbol, the side. The client might give you a price limit that I don't want to sell anything below this price, right? So that's a price limit. The time horizon, so the client will tell you that you want to trade 10,000 shares today only, right? And so your algorithm should automatically figure out how urgent the need is, right? So if he's given a time horizon, right, and there's only 1 hour left in the day, it's sort of pretty urgent, right? If there's still, if this number of stocks are less, you want to only sell say 1,000 shares in the whole day, then the urgency is not all that much. Now what people usually do is they sort of have different algorithms based on different symbols, and what they do is they have a liquidity and urgency framework, right? So they'll have it's low, it's not very urgent, medium urgency, high urgency, right? So on the right hand side it's urgency, and then for different symbols they will have different uh, classifications, right? If it is low, medium, or high based on how liquid the symbol is. So liquidity is liquidity and urgency, right? So urgency is this way and liquidity is this way, right? And you will have different algorithms for algorithm X, algorithm Y, and algorithm Z and whatnot, right? So just as soon as you receive your call, right, you would sort of figure out where it lies, right? Is it a stock which is very liquid, right? So very high liquidity, it's very less time left, very urgent, right? So you will use algorithm X to trade a very liquid stock with high urgency, right? So you will have different logics for different conditions, right? And this is what people do, right? So if a stock is very illiquid, right, you would you might not want to be very aggressive because the bid ask spread would be high, right? If it is very liquid, then the bid ask spread would be low, urgency is high, so you might want to dial up your aggressive knob, right? That means you might want to have a higher discretion range, and you might not want to be your pegging would be fine, but your discretion range would be very high or something like this. You see what I'm saying? So for different conditions you will have different algorithms, right? So now obviously what you'll have to figure out is that, so this is just an example, that if the daily volume of a given stock is 1 million, and your client calls you at 1 p.m. and he tells you that, what you want to sell, he wants to sell 0.75 million stock, 750,000 stock, then you'll just sort of bounce back this order. You'll say that, what, you'll not, frankly, you'll not take this order because it just cannot get executed, right? So this is the logic at the outside, right? Your order desk gets the trading symbol, the size, the price limit, and the time horizon. So if it fits your criteria for strategy, right, then you will calculate the time and the practical, and I'll tell you how to calculate the theoretical and the practical time horizon. But frankly, if it doesn't fit your criteria, you will just bounce out. You'll just bounce it back to, say, a manual trade or whatnot, not right. Your algorithm will not take such orders. I mean, you should have you should sort of, this is simply to tell you, you should know when to use your algorithm, right? And then I'll just show you how to calculate the theoretical and the practical orders, right? So the way to calculate, a simple way to calculate what is a theoretical time limit in which you can calculate, in which you can execute your orders, right? So say, you'll figure out the daily average volumes for, say, the last 21 days, right? So say based on the 21-day average, the 30,000 shares are traded per hour, right? So around 500 shares per minute. So you set the minute volume is estimated shares per minute, right? So this comes out to be around 500 shares per minute, right? And you'll calculate so this is the volume ratio, right? And if so, these are rough numbers that you can use, right? So if it is very urgent, then you can set your volume ratio as 15%. If the urgency is low, then you can set it as 2.5% and whatnot. Once you have this minute volume and this volume ratio, your theoretical time horizon in which you can execute the number of orders. So say you were asked to trade 10,000 shares, right? So just to be clear, so your theoretical time horizon is basically order shares, the share that you want to order, right, that you want to get executed, divided by ratio divided by minute volume, right? So say you have to order fire 10, you have to execute 10,000 shares, right? Your urgency is say high, right? Your urgency is high. So your wall ratio is 15%, right? So your volume ratio is 15%. For that particular symbol, your minute volume was 500 shares per minute, right? Per minute. So your TTH, theoretical time horizon, is equal to 10,000 divided by 15% divided by 500, right? So these many minutes. All right. So I'll just repeat the algorithm again. So this one, do you want to, Manish, is this the flow diagram that you wanted me to sort of discuss again? Theoretical one, all right. So yeah, so okay. So see, here we are just calculating the time, the approximate time that it will take for an order to get executed, right? I mean, for a client's order, right? Not a simple a limit price order. I'm not talking about that, right? So say the example over here is, say if a client called me at 10 a.m., right? And he asked me to sell 10,000 shares, right? And he asked me, to get the best price. Now, how will I know that, this can be done during a day, right? How will I know this? So, you know, so say he gives you that, you have to trade 10,000, you have to sell 10,000 shares of Microsoft, for example, any example, right? So what you will do is you will figure out the 21-day average volume for that particular stock, right? So say, 30,000 shares of Microsoft get traded in an hour, right? So that amounts to around 500 shares in a typical on a at a in a typical day. The stock gets traded around 500 shares get traded per minute, right? So you calculate you have the minute volume for that particular share, right? Volume ratio is sort of it's subjective, right? So if and it's a lot of times it's sort of given by our client that how urgent does he want to sell them? Does he want to sell them today only, right? And at any cost or whatnot, then the urgency is high. If he says that what, you can take your own time, you can do it in 2-3 days, that's fine. Then the urgency is low. So it's sort of subjective, right? So uh, it depends upon the client, right? Now, theoretical time horizon. How will you calculate the theoretical time horizon for? So this is basically the time that is needed to execute this order completely. How much time will I need to execute this, to trade, to sell off these 10,000 shares completely? So the formula is this: theoretical time horizon is equal to the number of shares that have been ordered divided by the volume ratio divided by the minute volume, right? So say wall ratio I've taken as 15%, right? Very high urgency. Order shares were 10,000, and for that particular stock, so example, say Microsoft, right? The volume is 500 per minute, right? 15% is just a number. No, it's just a number. It's just an example, right? So the theoretical time horizon will come out to be 133 minutes. So if you have 2 hours, only 2 hours left, right? If he calls you at less than 2 hours left, so say if he calls you at 2 p.m., then you will simply bounce back that order. You'll be like, what, there's too less time for me to execute this order. Let me not take this order, right? So you've understood what this 15% is very subjective, right? It just, you can set your own wall ratio, but this is what people use. If it is very urgent, then it's 15%. And it depends. So, I mean, I'm using as an example that, the client wanted to sell these many shares, right? You can have this according to your strategy, right? In your strategy, how important it is to execute a particular order, right? Yes, this 15% is fixed. This is not of, this is independent of the number of orders that you want to trade, or the number of stocks that get traded. This is sort of subjective, right? Only based on how urgent your order is. It's 15% is it's you can say that this number is 0.15, 0.075, or 0.025, right? I mean, the intuition is that these many orders will get trade. You will have to trade these many orders per minute, right? For to get it totally executed. So if the volume is 500 and you trade 15% of this 500, then in how many minutes will you get the whole order executed, right? So if it is, for somebody might say this as 30%. So this means that whatever volume is at 500 shares per minute, you will actually execute 30% of the 500, right? So something like the intuition is that. Why can't I take 10,000 divided by 500? Because you cannot trade 500 if the total volume of that stock is 500 per minute. There's only a percentage that you will trade, right? You cannot, you can't be the only one who's trading the 100% volume, right? So this volume ratio is sort of the percentage that you can trade out of a given volume. So if 100 stocks, 100 shares per minute are being traded, then you can trade 15%, and that would be like really urgent, right? So this is the sort of volume that you are trading for that particular stock. Yeah, is it clear? Any questions? Right? So this theoretical time horizon is simply, if it comes out to be 133 minutes, and you have only 1 hour left, then obviously you will bounce this order back, right? You frankly, you cannot have it. And then you'll have a lot of people have a maximum time limit that, I don't want to spend more than 2 hours for this order, right? I mean, there are other things that I need to do. So you can have a maximum time limit. I mean, it's up to you, right? So I've already discussed this. So this is clear, right? So usually per hour volume would differ a lot, right? So it's usually sort of an average. People just average it out, right? I mean, usually towards the end of the day there'll be a lot of volume. Starting of the day there'll be a lot of volume. The midday sort of, it's sluggish in that sense. So it's sort of an average, right? One question: why can't you sell all the shares in one go? Because you will impact the market, right? And there's not enough liquidity. So the bid ask quantity would be, say, 100 at each side, and you want to trade 10,000 shares, right? If you place a market order immediately, your the market will move tremendously, and you will get a very bad price, right? Because you'll get a very high price. So you want to slowly and steadily fire your orders, right? Why end of day there's a lot of volume? It's just empirical. Would algo tell what time of the day to trade? Uh, you can set such algorithms. I frankly haven't coded an algorithm that tells me the day. It only tells me the price, the symbol, the quantity, right? So, but there might be people who do actually work on this. Can we figure out on historical data? Maybe, I don't know. Maybe, but as I said, I haven't. Uh, what if I'm placing, Charles, let me not discuss dark pools and whatnot. I can take it offline, right? Can we calculate the ratio dynamically? This is subjective, right? So, I mean, if you want, you can have an algorithm for it, but this is pretty much subjective, right? All right. Okay. Now to the logic, right? How to blend pegging and discretion order. So I'll give you a very simple logic, and towards the end, I'll just tell you a simple logic that you can use for pegging and whatnot, right? Okay. So say you start observing your markets, right? So at the onset, you will just check whether the pegging logic is on, right? Just so that so pegging logic would be according to the best bid, right? So say you've placed a pegging order according to the best bid. Now you just want to, and you just want to have some criteria that sometimes the order book is not stable, right? Uh, it's possible that there are no bids. It's possible that there are no asks and whatnot. So you just have a simple logic to sort of figure out that the order book is stable. You have your bids and asks, and you have at least 5 levels of bid and the ask. So you'll have an algorithm that sort of checks this, and it will say whether your logic is on or not. If the market is not stable, then you'll just wait for 1 second, 2 second, whatever time interval, and then you'll start. If everything is fine, then you'll go to the next part, right? And then you'll check if there is a open discretion order, right? If yes, right, so if there is a discretion range that has been put in your order, you'll check that. If yes, then obviously you will figure out that is the discretion price greter than the bid or not, right? I mean, can it get executed, yes or not? So depending upon how, if the bid price is greater than the discretion price, right? This is actually the not the bid, this is the bid ask. So this is the spread. If the spread is greater than the discretion price, do you immediately want to get it traded, yes or no? So, right, so it will depend. If yes, then you just might want to wait, right? Depending upon how urgently you want to trade, if it will immediately get traded, you might want to wait. If no, then obviously it will get immediately traded, right? So, and if the spread is not greater than the discretion price, then you will obviously not use your discretion range, right? Then you will see, again, is there an open pegged order, right? So basically what you are doing, you are first of all checking if your order book is stable. Then you are checking if there is a discretion that can be used in the orders. If it can be used according to your urgency, if the bid ask spread is greater than the discretion price, then obviously it might get immediately traded. If it is not urgent, or if the bid ask spread is less than if the bid ask spread is greater than the discretion price, then obviously it will not get traded, right? Because your order will not get executed. If the bid ask spread is less than the discretion range, then you will check that is there an open pegged order, right? What do I mean by an open pegged order? Open pegged order is that, have I fired an order, right? Is there an order that already exists in the market, right? So this algorithm is working throughout, right? So it will have to check to fire a discretion order, right? It will have to check whether whether there is already an open order, right? So if the bid ask spread is less than the discretion price, then I could have fired a, a an order that can execute immediately, right? So I will check if there is an order, open pegged order. Do I need to modify it? Do I need to cancel it or whatnot? So it needs to check that, right? How does the logic of the spread greater than discretion price work? So say for example, where was my discretion orders? So it will, so say this was the case, right? So it will check. So here the spread is 0.4, right? Here the spread was 0.4, right? My discretion is 20 cents. So I know that my order will not get executed, right? So I will simply wait. If no, if it is less, then I will check if I already have a pegged order there. You see what I'm saying? This is for buy. This is for buy. Yes. This is for buy. So if I'm selling, does it mean I'm creating liquidity also? Would you share this flowchart with us? Yeah, I will share this PPT with you guys. Right? Uh, so okay, so let me just discuss this uh, on an Excel sheet, right? So okay, so I'll do that in a minute. So say you have your order book, right? Say you have your order book right here. So first of all, step one is you will check if your order book is stable, right? So this is the first step. So yes, right. If it is, then you'll go ahead. Second is if there is a pegging logic. So say yes, there is a pegging logic at 5 cents above the best bid, right? Then there's a discretion order at 20 cents, right? Discretion range is 20 cents. Please, discretion at 20 cents, right? So if the bid ask spread is greater than 20 cents, obviously I cannot fire a discretion. If I fire my uh, within my discretion range, it will not get executed. So I will wait, right? I'll wait. That's fine. If it is already so, right. So in this case, this is case one. I will wait for the bid ask to change, right? So this is case one. If my order book was something like this, right? Then I will check whether I already had placed a pegging order at 100, right? So that I need to modify and whatnot. Is this clear? So this is not bid. This is actually the bid ask spread. Bid ask spread is greater than the discrete. So this is a typo. This should be, the spread should be greater, right? Your pegging order will flash in the order book. Absolutely. So I need to check this because then I need to modify it, right? If I have a pegging order, then I need to sort of modify it. You see what I'm saying? I don't want two orders, right? So I don't want two orders in the order book, right? If that is how you want to trade. So if there's a pegging order, then I will modify it and then I will fire it, right? You see what I'm saying? Is this clear, guys? Any questions? Any questions that were left unanswered? At 100 or any other price, right? So if it is at 100, so if it is at 100, then only your discretion range will be at work, right? If it was anything below it, then your discretion range would not have worked, right? This flow diagram is basically monitoring the blending of pegging and discretion. Yes. How do I check if the order book is stable? Just that, there are bid and the asks, right? There are very rare cases, I would say, when, sometimes the bid there are no buyers. So there's basically zero bidders, or sometimes there are just zero sellers. So you just have to make sure that your algorithm is set for unstable order books, right? We are checking for a pegged order because if we have an open pegged order, then we would have to modify it. Otherwise not, right? So we should know what all orders we have in our order book, right? Any other questions? Any questions? So far this is clear? So far this is clear? Yeah? Any questions so far? Okay. So then if there is an open order, I need to check if a stub of pegged order remains, right? Now, what is a stub of pegged order? I will actually show you another flowchart for figuring out how to find out whether a stub of pegged order remains. Stub basically means if there was a partial fill on your order, right? So stub is if a partially filled pegged order remains, and there are some conditions, and I will discuss those conditions, right? So if say you had an order at 100 for if you had a buy limit order at 100 with quantity of quantity say 1000, right? So if this was the case, and you got a partial fill, right? So 500 shares got traded, right? Now you would want to check whether you want to use your discretion on a partial fill, yes or no, right? So, right, this is the condition. You might want to, a partial fill is indicating that, your passive orders are getting traded, right? So you might not want to use your discretion range, right? So it is important to check how many partial fills or fills you are getting on your passive orders. Is this clear? If yes, then you might want to cancel your peg order, right? Or you might want to be a little more passive, right? You might want to use a different logic for your peg, right? You might want to dial down your aggressiveness, right? If there's a if you're so if the whole order is there, then you just might want to see whether your peg order price is greater than bid and whatnot, right? So anyway, so if there was no open pegged order, and then the number of shares in reserve is greater than 0, that is, you want to, there is still some unfilled there is inventory for you to sell, right? Then you calculate the order and you fire the order, right? So if there was no pegged order there, then you would, and you had more shares to sell, then you will calculate the order and fire it, right? And you will calculate your order price and size based on the client condition, right? Has he set a minimum price? Has he set uh, a maximum order size and whatnot, right? So if the partial, so I hope the left side of this flowchart is clear, right? There's a question: if partial orders are getting traded, it has to be within the discretion range. Yes, so if so, it's quite possible that your order book, you were here, right? And you had pegged an order at 100 and it's getting traded, right? So a case can be formed that this was the order book, right? So let me just build a case, right? So this was your order book, right? And you had fired an order at 100 point, say at 100 for 1000 quantity, right? And you got a partial fill at 100, right? For say 400 shares, right? And then after this, the order book moves to, after this, the order book moves to 100.2, right? So now you can actually fire a discretion order, right? A discretion order, right? But my logic asks me to figure out whether I've got partial fills, right? If I'm getting partial fills, it's quite possible that I don't want to set my discretion order, right? It's quite possible that I might not want to fire a discretion order, right? When we are firing this 1000 orders, we are pegging it, right? So, okay, let it put it this way. So 99.95, and I fired an order because it was the bid, right? So this is the order that I will fire, right? Is this clear? Guys, is this case clear? Why I want to check for partial fills, right? Now this is important, right? Because I'm setting my algorithm depending upon the market conditions, right? Guys, is this clear? Yes or no? Any questions on this? What is not clear? Guys, please tell me exactly what was not clear. So why would I cancel the peg order if partial fills are detected? So okay, so you might okay, so the question, you might cancel it. So depending upon how aggressive or passive you want to be, you actually, first of all, if you receive a partial fill, then you definitely, it's quite possible that you don't want to send your discretion order, right? You don't want to use your discretion range. You might want to cancel your peg and you might just want to move back a bit, because you are getting your trades at that price and you want to figure out if you can get an even better price. So say you got traded at 100, right? And now you have a partial fill at 100. You might want to go back to 99.95, right? You want to cancel that pegged order and you want to move back because you want a better price every time, right? So if you have a trade, you just might want to move one tick below for some time to figure out whether you can get an even better price. All right? Is that clear? Carlos, Ravi, is that clear? Manish? Great. Right. It is possible to cancel partially filled orders. Absolutely. Absolutely. I'll just repeat. So once you've fired this order at 100 for 1000 quantity, right? And you get a partial fill at 100 for 400 shares, right? Now, and then, in your logic, you are checking, your ask, the market asks goes to 100.2. So you were ready to fire an order at 100.2, right? But you would check whether you got a fill or not, right? If you've got a fill, a partial fill, you might want to stop your discretion range, right? You don't want to send a market order. You might want to actually pull back because you are getting fills at 100, right? So you might want to move back because obviously you want the best price, right? So, okay, so there's a request for quantities. So say 200, 500, 600. So these are rough, any estimates, right? So this was at 200 to 500 and similar, right? So order books can change anyhow, right? So this was say 100, 400, 300 and whatnot, right? And then you fired an order at 1000 and then, right? So this is the order book, right? So then you get a partial fill. So this becomes 10,000 minus 400, right? So this becomes 600. Now you could have actually fired your discretion order, but then you would, because you got a fill, you would want to see whether, you want to move back or not. Is this clear? All right. And, if the whole pegged order, if you've not got a partial fill, then you can check. So, right, then you can check whether you are alone, need to adjust the peg price and whatnot, right? So, frankly, what I'll do is I want you to get familiar with this left hand side of this algorithm because this is the meat of the algorithm, right? The right hand side will talk about how to set a discretion range, how to set a price, a pegging price and whatnot, right? And you can have different algorithms to do that. And I will discuss a pegging order, algorithm, right, with you. But you should, so the left hand side actually takes care of how to, in an algorithm way, how to blend this pegging with discretion, right? So when you get, it's very important to check whether you are getting fills at your pegged price, right? And fire a discretion order only if you're not getting fills because you want to dial up your aggressiveness then, right? Is this clear? Guys, is this clear? And then frankly, the right hand side of the algo discusses how to figure out different peg algos and whatnot. So let me just, what I'll do is I'll discuss the flows, the algorithms for pegging and whatnot, right? A simple thing that can be used. Okay, so let me just first So you can have different algorithms to check whether you have a partial fill or not, right? Yeah, the right hand part might seem complicated, but frankly, and that is why I want to break this algorithm down, right? The left part is how you are checking your pegging and blending. The right hand part is the actual algorithms for pegging and discretion and alone set and stub calculations and whatnot, right? So if the left hand side is clear, let me go to the specific uh, algorithms to calculate stub orders, pegging, discretion. All right, is this fine, guys? Is this fine? Yes or no? All right, all right, great. Okay, so for example, this is an example of stub order calculation, right? How do I figure out? So it's not only that I get a partial fill, right? Stub order calculation might be even if I've got a partial fill, but you know uh, a small fill. So I'll just give you an example. So for example, stub order condition might be remaining order size is less than 20% of the order size, right? So that will count as a stub, right? So in this case, my original quantity was 1,000, right? But if my stub calculation is that I will consider an order as a stub order only if 20% of the original is remaining, right? So if this is my condition, right, then according to this, I will, in this case, I will use my discretion range, because I will say that what, my stub, this or this 100, this order for 600 quantity at 100 is obviously more than the 20%, right? So this is more than 200. So I will not consider this as stub. I will fire my discretion range, right? Yes or no, guys? So this might be one condition for defining a stub order or a, right? Or it could be that the remaining order size is less than 499, right? So the order is not less than 499, it is 600. So if had I defined it this way, then also, so these can be different conditions, right? So these can be no partial fills in the last 30 seconds. So if I got this trade at say 10 a.m. and I'm checking this condition at 10 o and 15, right? Then I have got a fill at 10 a.m. Therefore, this is a stub order, right? So a stub order, right? So based on my conditions, reserve shares is the number of shares that I want to sell, the total number of shares. So say I had to sell 10,000 shares and I've sold 9,000, right? So my reserve shares would be 1,000. I need to sell 1,000 more, right? So I can have different conditions, or I can actually I can combine these two conditions. I can have an and condition or an or condition, right? So these are just examples that we use for stub order calculations. Is that fine? You can absolutely customize it according to your own needs, right? Right. And then there was an alone flag, right? So, and I will tell you, so let me, and then there was a pegging price adjust condition. So let me just discuss a pegging price condition, right? So what you might use is, let me just copy my order book, right? All right. So say this was your order book, right? Now what I'm discussing is a logic for pegging, so that the market does not game you, right? So simple, you know what a simple pegging order would look like, right? A simple pegging order would be, 5 cents greater than the best bid, right? But this people can game you, right? So you can use a simple pegging logic. What is that pegging logic? You can have peg price say is equal to $0.05, right? So I'll just give you the logic, right? So please feel free to change it according to you, but this is and I will set a threshold, right? Say threshold is equal to 30 cents, right? So say you start this with this order book, right? What you will do is you will fire and say you wanted to buy 1,000 shares, right? You will fire 1,000 shares at 100, right? And you will note down the best bid when you fired your order. Is this fine? Right, guys, please pay attention. This is a very nice, smart pegging logic that I'm sharing with you, right? You fire this, your order book becomes this. Now you have 1,000 and at 100. Right, this is your order book. Now, if this order book, if there is some other guy, right? If there is some other guy who places the best bid when you fired your order was 99.95, right? Right? Now a person comes, right? And he fires a order for say 200 shares at 100.1, right? What you will do is you will check whether your price, right? Whether new, whether best bid minus the bid that you had noted is greater than the threshold, or is less than the threshold, right? If yes, then you will not move your order, right? So you will not do anything, right? So in this case 100.1 minus 99.95 is less than 30 cents. Therefore, you will not do anything. Is this fine? Right. If the order book, if there's another guy who comes at he removes it to 100.2, right? Then also you will not do anything, right? Because this is less than our limit. What is 30 cents? 30 cents is the threshold, right? This is the threshold after which you will move your pegged order, right? Okay. We will fire a pegged order, right? We will fire a pegged order if there's somebody who goes to 100.3, right? Then we will check. If no, right, because now 100.3 is actually greater than my threshold, then I will fire a pegged order, or I will modify my pegged order at 5 cents better than the bid, right? So then if I fire it, then the order book would be so this order will get removed, and this would be 1, this would be 2, and this will be the order book, right? Right? Is this clear? Yes, the threshold is protecting you from pegging, right? So I will only move if the order book has moved, if the best bid has moved more than my threshold, right? Is this clear? And in this case, what people usually do is they have pegged at 0 cents, so that if this is 0 cents, then the person who's firing at 100.3 will get traded first and you will get traded after. So you can actually prevent anybody from gaming you. You see what I'm saying? Yes, I'm sorry. This would be at 100.35. I'm sorry. Thank you. So, obviously the new order can be a spoofed order, but if you're, this is, so if he is this close to the ask, it's quite possible that he will get traded, right? So people might not want to jump to this close to the ask, right? So, people who are spoofing have to be very clever about it, that they don't get traded, right? So if they are too close, it's quite possible that they get traded, right? And that is why the threshold helps us. And this threshold is sort of according to the bid ask spread, right? So the bid ask is say 50 cents. This threshold would definitely be greater than the bid ask. So if it is around 50 cents, I'll put it at, so in this case it was 55. So I would put it at 30. If it is around $1, then I would definitely, this threshold would be greater than 50 cents. Is this clear? So yeah, pegging price. So this was at pegging price was 5 cents. Usually what I would recommend is you can peg at 0 cents, right? So you can fire the order exactly at the bid price. Because if somebody is sort of spoofing you, right, then your order, if you are at the bid with somebody else and a trade happens at the best bid, then the person who came there before you would get traded first, right? Because of price time priority, right? So he needs to be, I mean, if he's spoofing you, he will pay the price of getting traded, right? Or something like that. The threshold limit should be more than 50% of the average bid ask spread. All right. Is this clear, guys? Yes, you are definitely buying at a higher price, but if the bid is moving and moving, and just imagine for a second that nobody is spoofing you, and the bid is moving. This probably means that there's an uptick that is possible in this stock, right? If there's an uptick coming, better that you get traded at 100.35 than at 101 or 101.5 when the uptick has happened, right? Is this clear, guys? Is the logic clear of pegging, right? So here, this is what it is doing, right? Pegging upper threshold and lower threshold and whatnot, right? And you can obviously adjust it accordingly, right? Guys, is it clear? Yes or no? Great. So, I mean, just take your time to sort of understand this. Obviously, if you have questions, you can obviously email me, right? But I mean, the simple, this, you can have your own great logics for pegging, for discretion and whatnot. I am just here giving you, just sort of a start, right? To say, right? Which is pretty decent, and I know people who can use this, right? So threshold I've discussed. We we can stop spoofing because I mean, in this case we stopped spoofing because we had a threshold, right? If we had no threshold, then for every better bid we would send a higher order, right? And it's quite possible that the person goes at 100.2, you fire at 100.25 and you get traded, right? But here, because of this threshold, the person would have to cross half the bid ask spread for you to fire an order. So that is how you sort of stop uh, the spoofing, right? So okay, there's a question about stub. So if I won't trade unless I get filled 80% of my order. So no, so I'm just saying that you can calculate your stub order through your different logics, right? I mean, it's up to you what logic you might want to use. Say your logic was that what, I will consider an order as a stub order only if 20% of the original is remaining, right? So if you've traded 80% of your order at 100, then you might want to lower your price, right? You got an 80% fill, you've traded, say you had fired a quantity for 1,000 shares, 800 gets filled, and now there's a question whether you want to fire a discretion order or not. You probably would want to wait, right? You might want to even decrease your price because frankly you've got a nice fill, and you might want to lower your price so that you can even a better price. All right, Alejandro. Can I give an example of how trader A can game trader B in a minute? Akshay, let me just answer your question in a minute. Does this discretion work in anything other than HFT? No, it needn't be an HFT order, right? I mean, you can do it for simple algorithmic orders, right? I mean, this trick can work for any order. Is there a way to choose a tight spread when you place a limit order? Tight spread would be, you'll have to do some calculations based on historical data. What is the average spread? You know, what is on an average is the bid ask spread 10 bips, 20 bips, and whatnot. Sell would be for the same. If we use the threshold, then it means that we are waiting to fire the order, and this means market can go up and we end up with an expensive bid. That is true. Obviously, this will come at an expense of people not being able to spoof you, right? So just an example of how people can spoof you, right? So if this was the order book, right? So say the fair price is mid, right? So say it is 100.25, right? So 100.25, right? If you have a simple pegging logic would make you fire an order at 100.3 if there is an order at 100.25, right? Now remember 100.3 is actually greater than half the bid ask spread when you first fired your pegged order. Is this clear? Guys, is this clear? Is this statement clear? Yes or no? Guys, are these two lines clear? No, so say if this was the order book, right? And a simple pegging logic is that you are 5 cents better than the best bid always, right? So simple pegging logic would make you fire an order at 100.3 if there's an order at 100.25. Yeah? Guys, you're not listening. No, I mean, this is not any rocket science, right? I mean, please pay attention, right? So, is this line clear? I'll just show. So, guys, remember, the game aspect is somebody fired at 100.25. That was the fair price. That's fine, right? Now you fired an order at 100.3, which is actually greater than half the spread, right? Which is basically you are now firing an order that is above the fair price, right? So eventually you are at a loss. If you are firing at 100.3, you are at a loss because say the fair price was 100.25, right? So this 100.25 order has actually made you pay a price, right? And it has made you pay a price because you've now fired an buy order that is greater than the fair price. This threshold thing would avoid such things, right? That is all. Yes, you are getting a higher price, but you are not getting spoofed, right? You are getting at a higher price because the market might just want to move, right? It's quite possible. If somebody places an order at 100.3, which is already greater than the fair price, then that means it's quite possible that the market might move up, right? That is the point. So obviously you have to, if the market keeps on increasing and you don't get a fill, then obviously your discretion range will also come into play, right? So if you're not getting fills, then obviously you have to turn on your aggressive knob, which is your discretion range, right? Is this clear? Guys, is this clear? Yeah? All right. Great. So the bid decrease logic is if you have a stub, right? If you have a stub order, if you get a partial fill, I mean, I'm just saying that you can fire in a logic where you just go 5 cents below the best bid, right? Or your existing order, right? So that you get a better price. That's pretty much it, right? Right. So, and then there can be pegging is used only if you want to expedite the firing. So that's actually for discretion, right? All right. So let me take the questions in a while. I'll just move ahead. If there's any question left, I'll take it at the end of the lecture, or probably you can email me, right? Because I need to complete this. And then you can obviously have a size check, right? So you now, you know, just like for pegged price, you can have a pegging order check for size. You will only peg your order to the best bid if the best bid is higher than a particular size, right? So for example, if this was the start of your order book, right, you will only peg if the best bid has a size of more than 500 shares, right? So you can have a size check in your pegging orders, right? And then, right, and also you can have a size check on your quantity, right? That you will not bid more than, so if the best bid has 100 shares, you will not bid more than 50% in your pegged order. So you will fire an order of 50 shares at 100, right? Something like this. So you can have size checks on your pegged orders, right? So discretion, all right. This is the final how to figure out the discretion range, right? The base discretion range, as I said, is usually calculated based on a percentage of your expected spread, right? So historically, you will figure out that this is the average spread, this is the probability of getting executed. So this would be a good discretion range to maximize the probability of getting traded, right? Also, if people can use trends, right? If the market is sort of trending, right, and you can have algorithms to calculate if the market is trending, right? In the last 5 minutes, if the market has moved by 50 bips, right? So the market might be trending, right, or something like this. Then you can increase your discretion range by 1 tick, right? So if your discretion range was 20, you might want to move it to 25 cents, right? Or zero if there is no signal. If it is sort of mean reverting, then you can actually decrease it. So this is somewhat a dynamic discretion range. How to get the historical spread? By historical data. You'll have to, bid-ask data is you'll have to buy it, or you'll have to ask your broker if you can provide, right? So trend or no trend, you can sort of dynamically change your discretion ranges, right? If the stock is very liquid, right, then you can add 1 tick. If there's a lot of volume that is getting traded, the bid-ask spread is narrowing, then you can increase your discretion range by 1 tick, because that you will, there's a high probability that you will get your trade, right? And you can use such formulas, right? Based discretion range plus trend plus liquidity and whatnot. So it's a function of all these things, right? So this is basically it, right? The summary of execution is pegging order agent will continuously send out passive orders, right? Discretion will work in tandem and it will send out aggressive orders so that you get more fills, right? If you're already getting a lot of fills without using the discretion range, then you necessarily don't have to use your discretion range, because even if being passive you're getting fills, you wouldn't want to use your discretion. But if you're sitting there for a long time and you're not getting any fills, you might want to jack up your aggressiveness, and you might want to use your discretion, right? All right, so this is officially the end of the lecture. I know there was a flurry of questions, right? So let me be here for another 10 minutes and I will answer any questions that were left, right? Okay, let me just take these questions now. Finally, the discretion knob regulates the level at which you will go to the market to get your order finally placed. Absolutely. So that is the aggressive knob of your strategy, right? Half the bid-ask spread, please explain meaning of this. Half the bid-ask spread. So the bid-ask spread here is, what is the bid-ask spread here? It is 55 paisa, right? So bid-ask spread is 55 cents, right? So half is around 27.5, right? So 100.3 is, you've moved above. So 99. So basically it means that you've moved above the fair price, right? Or you have moved above the fair price, right? Is there a way to integrate Python in VBA? I'm sure there is, but we can discuss this offline, right? Is there, we can discuss this offline, Charles, right? How to get historical spread? I've already said you'll have to buy, the data from your vendor, right? What if someone puts in a bid for 1,000 for one quantity, right? So exactly, right? So that is where you have your size checks, right? When you are pegging, it's not, just don't rely on the price, right? Rely on the quantity too, right? So you can have a logic that I will not put more than 50% off. I will not peg my order, not put a quantity more than 50% off of the order that already exists at the best bid, right? If the fair price is trending, then our fair price itself is not fixed. Obviously, it is not, but right, I mean, that's how markets move, right? All right. How do we know that our pegging of how bid ask is right? You don't know. I mean, I just frankly, this is a logic that I have shared with you with some experience, right? I mean, please don't take any advice from me without back testing. I always say this, right? Back test your results, your strategies, your ideas, and it will be clear to you, right? Any question that I missed? Any questions that I missed? Pegging and discretion orders consider hidden orders. Now, hidden orders by definition you cannot figure out, right? So if there are any hidden orders, pegging order will not be able to, your code will not be able to figure that out, right? Yeah, so obviously, please guys, please be absolutely sure the logic that I showed is not a strategy. It is only how to manage execution of a strategy, right? So I told you in the beginning, right? There are two parts to any successful idea. There are two parts. One is the strategy itself: when to buy, when to sell, what to buy, what not to, how much to buy. Once you've sort of figured this out, then you sort of use the execution logic, right? And it might seem that execution is not important, but I'm telling you, I've seen ideas, similar ideas. One is working because it had a great execution logic. Second word not working because it didn't have a great execution logic, right? So execution is very important, and this class was only about executing a given strategy, right? Yeah, please email me if you have any doubts. I'll be more than happy to set up a call. Absolutely, that's not a problem. And it's great if you go through support, because they're after my life if I don't answer your questions. Right? No, I mean, I'm just kidding, but no, frankly, they absolutely keep a check whether all your questions are the. I will share this Excel also. Don't worry about it. I will share this Excel. So, I mean, frankly, if there's a hidden order, then you cannot peg against hidden orders and whatnot, right? What is the best way to backtest realistically? Because you cannot figure out gorilla algos. No, you know what? If you observe the historical data, right, you can actually figure out, and I've done it myself, right? I'm not saying, I mean, I have sort of, I know there are some particular stocks where people used to gain, and if you look at the data closely, you can figure out that this is what happened, right? I mean, sometimes it is after effect, after 1 day of trading, you figure out that what, this did not go well as I had thought, and you sort of minutely observe the data and you figure it out. But I'm telling you, you can easily figure it out. The way to backtest an execution strategy would be, you you will be able to quantify the once you have the logic, you will be able to quantify the parameters, right? The bid ask spread, right? That this is a good bid ask spread, and that this is a good discretion rate. And I've given you a simple logic, right? That you can use this logic, you can actually quantify the parameters through historical data. Use this logic, right? And then once you are in the market, you can improve your data, your algorithms by more and more experience, right? But I've given you a decent start as an algo to work with, right? Right? All right. So what I'll do is, I hope. All right. I'll just take last two questions. Can I please explain how to get trend while deriving discretion rate? Yes, absolutely. So there can be a lot of different algos to determine trend, right? One simple algo is just try to find out the slope of the price change with respect to time, right? So say in a minute the price changed by 50 cents, right? So the slope is 50 cents divided by 1 minute, right? So 50 cents per minute. And then you can have a threshold for that slope, that if the price change is more than 50 cents a minute, I will say that this is trending. If it is less than 50 cents, if it is changing by only 20 cents per minute, I mean, these are rough numbers, right? Usually it would be around 10 cents in 5 minutes or something like that, right? And you can have a slope or something like this, right? That if the price change is greater than a particular threshold in this given time frame, then the market is trending. You see what I'm saying? Yeah. Is that clear, Sanjay? Can we really know when the stock will start trending, my friend? You can. It's to predict prices is a different game altogether, and I usually work with statistical arbitrage strategies. So I try to find out opportunities in mispricing, right? So I don't know whether you'll call it predicting or whatnot, but yeah. So I mean, we can discuss it offline anyway, right? By, yeah, a lot of people do it by audiobook, but we'll discuss instead online. Sanjay, was it clear? Right? All right. So, thank you so much for attending this lecture. You know, I hope I was able to answer most of your questions. If there were any question missed, I sincerely apologize. Please feel free to email me. I've been getting questions, and I hope I've been regular in answering those questions. You can set up calls. There were two questions that I sort of thought that I'll take in this lecture, but time did not permit me. What I'll do is I'll probably individually set up calls with you guys and answer those questions, right? Because they were sort of offline, but I mean off topic, but that's fine, right? I'll set up calls in the next week, and we can do that. I will see you actually tomorrow again. Oh my god, you guys are really stuck with me. No, but tomorrow, I really like tomorrow's lecture. It's the beginning of stats. I will see you tomorrow. Till then, have a great day. Please just go through these slides again. It can be a bit overwhelming, but I hope the logic was clear. I will see you tomorrow. Thank you so much for attending this lecture. All right. Bye guys.